What's going on out there? It's Wednesday, July 13th. I'm Frank Curzio, the Wall Street Unplugged podcast, where I pick the headlines and tell you what's really moving these markets. Today's fun day, Wednesday day, Daniel Creech Day, Senior Analyst, Curzio Research. Dan, what's going on, man? How's everything?
Frank, I like that Daniel Creech Day. You know what today, National Day is today?
Oh, what is
I know. It's ridiculous. There's something for everybody. But today is National French Fry Day.
Is it National French Fry Day?
Heard that on the way to work this morning. Yeah, French Fry Day.
Yeah, it's every time I look, there's like 10 things listed as that day.
Yeah.
Everything's a day.
I'll tell you what the most important thing is, in my opinion, today is it's Open Eve. So the Open for golf starts tomorrow over at the Old Course back at St. Andrews.
Yeah, it should be pretty nice.
I'm excited about that. What is it, 5-6 hour time change? So I'll be at work early tomorrow.
Be at work early, yeah.
Watching my iPad.
Yep. I hear you. Well, if you're watching on YouTube, it's nice because you have a little bit of a different background than you have Daniel with no background. So you look like you're in the middle of nowhere. It looks like there's a green screen that's going to come in, but it's cool.
Yeah, but there's not.
Yeah, we took everything down. We set up a studio in Vegas, and of course, on the way back, that's the bag that didn't come. And so, Daniel, you're like on an island by yourself. It looks like you're taping in the middle of nowhere, which is cool. So
yeah. I'm in my comfort zone then.
You're in the comfort zone.
Island all by myself.
Oh, it's perfect. It's perfect. So let's get to it because there was a little bit of news today. A little bit. It wasn't that big of a deal. It's like the Consumer Price Index, CPI.
Yeah.
I mean, it's being talked about a little bit today.
Mm-hmm.
Yeah. What are your thoughts?
Well, it's going to be easy to point this. I'm not surprised that it was a little higher. I am surprised, the 9% year over year hurts. 9.1%. I think 8.6 was the consensus. So that sucks. I mean, prices in reality, we all feel it's a lot worse than that. I do like to see the market coming back. I got to give credit where credit is due. I'm not the biggest fan of Jimmy Cramer, but he made a point when the numbers came out. There was a good discussion on CNBC this morning that I was watching when Santelli and everybody does and Leishman, they go back and forth and they're good characters. But Jim came on right before the 9 o'clock segment, which he's on, and was saying, hey, listen, these numbers are taken at the worst time because it doesn't price in, the inflation doesn't price in the significant drop that we've seen in energy, not so much food, I don't think, but retails, employees, separate things like that. And you've talked about this in the past on, hey, we got to be close to peak inflation.
Yeah.
We certainly hope so because, I will say, I'm surprised that the market is coming back, especially the NASDAQ. I mean, we're taping this midday, but the NASDAQ was down 2%, I believe, at open, and it's green now. Does that say signals are all clear? No. However, I do think that that's strong to see the market come back, inflation, as they expect. Hey, your hands are tied at the Fed. You're hiking 75%, or 75 basis points, excuse me. A little bit of a difference there. 75 basis points at the end of this month, guaranteed, maybe even 1%, in my opinion. What do you think on that?
There's risk that you have to be concerned about, and then there's headline risk, right? And this is headline risk. And it's important for you to know the difference because, we said this 2 weeks ago, 3 weeks ago, that, we're kind of close. I thought we would hit peak last month. It's definitely going to be peak this month. I'm not surprised it's a little bit higher. Not only have we saw, and again, this is not this month's reading. This is last month's reading. What do we see? We saw gas prices hit record highs, right? It's $5 a gallon. On average, we're seeing, a lot of the data over the past 3 weeks, especially, has come down significantly, which we've been talking about. So next month's data is probably going to be a lot weaker, like much, you're going to see inflation just moderate. It is going to come down to, and again, when the headline comes out, everybody overreacts, but this is a lagging indicator. And when you look at the data, right, so we're looking at CPI up 9%, 9.1%, higher than the 8.8%. And you kind of knew it was going to come out higher because not Wall Street, but, the White House did a great job leaking this to the media because the last 2 days I saw 20 stories saying it's likely going to come in higher. It's likely going to come in higher. It's likely going to come in higher. So, it was a good job trying to anticipate this. And the market's initial action was like, holy shit, right? And we saw, I think, the 10-year go up to 3.2 or 3.1, and now it's back to 2.8, I think, last I saw. So, the Dow's still down a little bit. Again, we have inflation, but we need to see it moderate. But if you're looking at the bigger picture here, oil was $130, it's $96. And a lot of this came down recently, and this isn't being factored in. Gasoline price of $5, a little bit over $5 on average. They're $4.60 on average right now. That's a significant difference. It was $3 and change a year ago, so we're still paying much higher prices, and we're still going to feel it. What's important is this is dictating Fed policy, and Fed policy drives the markets. So this isn't like, Frank, we still have crazy inflation, it's still high. This is all about the Fed policy. Because nobody, when you have uncertainty what the Fed's going to do, that's what leads to the risk of the market. And that's why we saw everything crash as much as it did, because the Fed had no fucking clue what it was doing, right? It was transitory. Then it's not transitory. It's going to be the highest inflation we've ever seen in our lives, like in a minute, right? So finally they got it. But now the Fed's ahead of the curve. They're doing their job, right? So again, you can destroy the Fed. People love destroying the Fed. But you're seeing, the big result is when you see inflation is commodities go through the roof. And that's what we saw. It was hard to lock in prices for home buying. If you're building a house, you know what I mean. Copper prices are $320. They were $460 a month ago. Lumber was $1,300 in March. It was $1,000 in May. It's $680 now, right? So we're seeing it almost on every single level. And you're also seeing more layoffs being announced, which means what? You're not laying off people if you have pricing power. A lot of these companies have pricing power. That means they're raising prices. When they're raising prices, that's why you see inflation go through the roof. And inflation is going through the roof because people are paying these prices. When they stop paying these prices, that's different. But now you're seeing a lot of these companies start laying off, especially in the technology sector. And as they're laying off, that means that they no longer have that pricing power, which is telling you that inflation is going to come down. So to me, inflation is more predictable now than it was over the past 15 months, 18 months when you're looking at the Fed. Now you're going to see inflation come down. The bigger risk, what I think, again, that's why you see the market come back a little bit. The bigger risk is because now you can dictate what the Fed's going to do. It's a 75 basis point rate hike that we're expecting. But after that, if the numbers come down significantly and then significantly again, the next meeting, so the next Fed meeting's at the end of this month. It's a couple weeks. They're probably going to raise by 75 basis points. And then the next one, I believe, is in September. You're going to get 2 more readings. Those readings are going to be weak. They're going to slow that. They're not going to go 75. I'll be surprised to go 50. They might even say, okay, we're good because we're a lot higher. And that's going to be a catalyst for the market, which we've been saying. So the bigger risk I see here, Daniel, is labor. Delta reported record revenue, but margins fell, and they fell pretty hard. And they blame fuel costs, which is fine. That's temporary. Fuel costs are down now. Again, fuel costs will eventually come down. That's what I believe. But the big thing is the labor, and they can't get pilots. So now it's just like the restaurants where you're seeing strong demand. You can't get the people at work. Then what do? Right? So the labor situation right now, whatever happened during COVID, that is like a major, major concern. I think people just were staying home and say, you know what, I don't have to go to work every day. I'll find other jobs that I could do. But they're having trouble. And if you don't have pilots, that means you can't keep up with demand because you're seeing record revenue. But obviously you have to pay your pilots more. You have to pay. That's a pretty big issue we haven't addressed yet. But let's see, because when I say the Fed's doing its job, you're looking at income and wages are coming down. So when they're coming down, that's a pretty big deal when you're seeing prices going up. So it's just a matter of time before inflation comes down. This number didn't really surprise me, and the market coming back didn't surprise me. But the next thing that we need to worry about, because inflation's kind of getting predictable now, you're going to see it gradually come lower and lower and lower. We're seeing it in all the data points. And again, this CPI is a lagging indicator, which is showing, in the past. But if you look at the last 3 weeks, this number should, if we hold up here, this number should be, significantly lower. Like significantly lower where it'll create like a nice headline number like it did today where the market might shoot up. It's the labor that's my biggest concern.
Well, and I don't see how that's going to get any better. I'd like your opinion on this, but how are we not just set up the stage for stagflation? So even if inflation doesn't continue to go higher and higher, let's say it goes down a little bit, it's still really elevated, especially on a year-over-year basis. And how can wages increase any amount significantly from next month's reading to August to September? I just don't see how that's going to happen, which means there's just a lot of pain there. I think you're right on, man, if the Fed, I think the Fed, the only reason they pause in September is because it's a midterm election, and I know I like to get into politics. That's my opinion on that. If they're serious about fighting inflation, though, how do you pause there? Why don't you keep going?
It's all data-based.
Well,
so it's based on the data. I'm not saying that, for me, I think the data is going to be significantly lower because what they're doing is not only going to report recession, right? We're going to go into recession here.
Yeah.
Now you're looking at depression. If you're continuing, they didn't go far enough. And we all know that. Now they're going way too far. It's too far, too fast. And you got to this takes time to adjust, just like inflation takes time. And you're like, well, it's supposed to moderate. It didn't because you filtered the market with money in a way that you've never did before. You handed it directly to people. You didn't hand it to the banks to shore this up. You didn't, hand a little bit. You handed $11 trillion, right? And then you handed almost half of that. When all the asset prices came back and everything was at all-time highs, houses, household wealth, cars, everything, every asset you own was at all-time highs, and it was pedal to the metal still. And the politicians still wanted to keep going. Okay, Build Back Better. Thank God that didn't get passed. It was like, just keep going and going and going and going as long as we can until we can't anymore. And now you're seeing the leverage process. Now you're seeing it in risky assets. You're seeing the small cap index, Russell's trade at its most attractive valuation in probably 25 years. It's never been here, right? Yeah. So in terms of valuation, you're looking at Bitcoin, all leverage coming out, which is a great thing, right? We just came back from the conference and the amount of ideas that we saw, it's just innovation is incredible, but you have a lot of shit in that. So you're seeing the leverage, all the garbage come out of the market right now. You got to be careful that you can't go too high. So by going on hold in September doesn't mean that you can't come back and raise, but I think you're going to see significant amount of numbers where inflation is going to come down enough to say, okay, well, maybe we can pause. Let's see over the next couple months and see what happens. That's what I think. But if we get another high inflation reading again, which I don't see based on the data, this isn't a guess, this is the data. Everything's really down over the past 3 weeks, which this current number is not factoring in. And that's why you're seeing the market come back. It's going to be interesting, but I think we're at peak inflation. We're going to be at what, 2.5, I mean, if they raise 75 basis points, that's what, 2.5, right? And then if they raise another 50, we're looking at 3. At 3% by next year, now if you see inflation coming down, to 4%, 3%, now the Fed's in position to say, okay, now we can stimulate the economy a little bit and start lowering rates. Again, this period right here is going to be incredibly, incredibly ugly. We're going to see the numbers come out for this month, and last month was the absolute worst month. I don't see it getting worse because you're seeing companies lay off. They don't have the pricing power right now. You're seeing commodities absolutely crash. So that's why I feel they might say in September, depending on the data, if I'm right on this, depending on the data, we've been pretty right predicting this for a very, very long time, that we're close to peak, but it's going to be interesting to see what they do at the September meeting. This meeting is pretty predictable. It should be a 75 basis point hike, but let's see what next month's data and the month after that. If they come down significantly, Fed might be like, look, where we are, it's working. So let's stay where we are because it's putting a lot of pressure. Rates are higher, less borrowing. The housing market's come down significantly. You're seeing prices start to moderate in areas. That's the big factor there. So we'll see. It's based on the data. It's not like it's definitely going to happen or not. Next month, I might say you need another 75 basis point hike immediately. So let's see what happens with the data right now. The data is telling me that one more 75 basis point hike, and there's a shot that they can go on hold in September.
You think Powell's got it in him to do a 1% at the end of this month instead of 75?
No, he won't do 1% because they're seeing the data that I'm seeing now. They should be smart enough to realize that this could hammer.
Oh, don't give him credit there.
This could destroy and hammer us. This could hammer us if we go too high and swing the pendulum the other way. It's gonna be even worse than what inflation is right now because at least people are working. They have jobs. The labor market's still okay. The banks are in great shape, right, in terms of the capital on the balance sheet. So it's not like an end of the world scenario. When you have a massive recession to the point where it's near depression and you're going to push us near that, that's the bigger concern right now because you are seeing inflation moderate in a lot of different things. You see gas prices, guys, are definitely down around, they have to come down a lot more. You need to see moderation. That's what the Fed wants to do. They want to stop it. And when it stops, now they can look at data and say, okay, do we need 25? Do we need 50 basis hike? But so far what they're doing is working. You're definitely going to see it in the data next month. So, yeah, I don't know.
I like that. We touched on this a couple of weeks ago because the crazy thing on when does the markets take off and what do the markets like to see? And I like how you pointed out that the Fed policy is now driving the stock market, has for some time since the whole transitory switch. This is from Goldman Sachs global market strategist Vicky Chang says that going back to the 1950, the S&P 500 has sold off at least 15%, 17 occasions. 11 of those 17 occasions, the stock market managed to bottom only around the time the Fed shifted towards loosening monetary policy again. Now, what I want to look for is if we get the pause in September, I don't see how that's not bullish for markets. Mm-hmm. But some forecasts, depending on where you're reading, you're looking out into the first quarter or maybe the end of the first quarter next year if they do a rate cut. We talked about, we threw out some fun stats last week on, hey, if they get to 5%, it'd be just interest on the debt would be so high. I don't think you have to wait until that point, but that's an interesting data point to me that we'll see where that stacks up because, they are driving the market. They've been driving the market for a long time. And I do it'll be interesting to see that. I know we can wade into things until then, but until then, I expect the market to be. I just think the easier road, the road less traveled, is lower.
So here's how I look at that data, right? So I look at that data, and I haven't seen that yet, right? You said 50, it's down 15. When it's down 15%, usually you see the market bottom when the Fed starts easing a little bit, or announces they're going to ease, right?
Shifting,
tightening. Okay, now, that's fine. So people might be like, okay, I'm going to wait, and that could be to next year. We're down 30% on NASDAQ. We overshot, right? Yep. So now that's why, for me, I'm buying stocks, because we totally overshot, knowing that the news coming out over the next 3 to 4 months is going to be horrible. But there's a shot that we are very, very close to bottom, especially if inflation moderates and the Fed's still raising rates. Yes, I like where the 10-year is. It's not going much above 3%. I like that. I mean, it's not going 3.4, 3.7. It's not going a lot higher than that, which tells me that, we're pretty close in terms of inflation moderating. At least that's what the market's pricing in. And usually the market is right. So just when I look at that data, you have to say, okay, well, we're down double the amount they're talking about. Yep. So why don't you take the survey and see how many times we went down 30% and how long it took? Because I can guarantee you you're not going to wait until the Fed actually gives a green light and says, okay, we're stopping. Now we're going to look to lower to stimulate the economy. It's going to happen much, much, much quicker than that, especially with the amount that we're done. So that's why when you're looking at data points, to me, I like to break down the data points. And being down double the amount that they've put in there that she's monitoring makes me think like, we're probably a lot closer to the bottom. Remember, a lot of this is factored in. I know it's hard to see. Like inflation, holy shit, my portfolio's down. Your portfolio's getting murdered. You're down tremendously. A lot of people are down tremendously here on good names. Now you're going to see the separation. You're seeing it with Pepsi. Pepsi, I don't think announced layoffs. I didn't see that, but they had a great quarter. They have pricing power. You're going to see that from Coca-Cola. Some companies have pricing power and they're good and they're not laying off. But when you're laying off employees, it's saying that I don't expect the revenue to keep at it where it is. So we need to cut costs. That's going to result in probably earnings meeting their estimates for a lot of companies. We'll see. But that's going to be based on cost cutting. And you're seeing more and more companies lay off, showing us. So that tells me that, okay, if you're laying off, that means you're expecting a slowdown. I expect that, you're not seeing, you no longer have that pricing power, which you had over the past 12 months, at least 18 months or whatever. So, but it will be interesting, right? It will be interesting. This is just, everybody has the opinion here. We'll see what happens, but you got to be willing. The most important point here, Daniel, and we say this all the time, you have to be willing to switch on a dime. You can't be like inflation. You're right. Inflation. We talked about inflation, but eventually the Fed is going nuts right now, doing something that's unprecedented, raising like crazy. I don't want to say unprecedented because it didn't happen until they did in the 80s. You have to be willing to switch on a dime if the data changes. The data is going to change significantly over the next 3 months. It's going to look horrible. We're going to fall into recession. It's going to look terrible. But remember, stocks right now, where they are anticipating that. Anything better than that, then we definitely hit bottom. But let's see.
Yeah, I agree. But the biggest driver of stocks has been the Fed forever. And now until they change course, that's an interesting point. So, yeah.
Well, this is the first time in a long time where the Fed has not been predictable. Usually they had a habit of coming out after 2008, 2009 of saying exactly what they're going to do, predicting what they're going to do, and telling you. They have been totally 100% wrong. They said, we're keeping rates low. They kept rates low. But usually they come out and they're predictable. This is one of the first times I can remember when the Fed said, it's transitory. And they didn't say, wait, it might not be transitory. They said, it's not transitory no longer. It's going to be the highest inflation that we've ever seen. So, it's a total 180 from the Fed, which since 2008, 2009, a credit crisis, that's been the Fed. That's been the change in the Fed. You guys come out and talk about what you're going to do in the months ahead. This way we ease into it and there's no surprises, because sudden shocks in the system result in what we're seeing right now. They had a shock in the system, and that's why the market's all over the place, because they don't know what the Fed is going to do. And that the Fed is, again, the gorilla in the room. That's what's going to force people's hands in terms of spending. That dictates it based on policy and where rates are. Now you're seeing it where, okay, it's getting a little bit more predictable here. And the more predictable it is, the more people are going to be comfortable. You remove that uncertainty from the market, and you're going to see more and more people come into this market, and probably the market finally bottom. Hopefully. We'll see.
Hopefully. I'm with you.
Okay, so let's go to one more story here, which is Twitter. Man, this is
the sitcom version of the market.
Yeah, let me hear your thoughts on Twitter. I mean, it's everywhere. There's number one story. It's on social media. Everyone's talking about it, whether it's the market or not. It's front page news every place. So
the best thing that I read and watched was when Faber pointed out, and I'm not saying that he's wrong legally or that this couldn't happen in theory, but now Twitter is, Twitter dropped the other day because Musk officially pulled his deal. So it was down, 10 or 11% into last week. Mm-hmm. Then it popped a little bit yesterday or this morning. It's up this morning, or it's up today, because now Twitter's going to sue him and just say, hey, we had a deal. You're buying us out. We approved it. You signed it. We're good. And now the CNBC conversation was great because he said, hey, where do we go from here? They're going to go to court. And did you see how many days they're asking for? I thought this was cool. This is not, I don't want to use the word cocky, but I like this confidence. The Twitter lawyer team members are asking for 4 days in court to prove their case. So you got to feel pretty confident if you're only asking for 4 days. So the couple of scenarios that they were playing on CNBC is, hey, either he forces his hand, judge says you got to buy him, so he buys him. Or the judge says, nope, all you're getting is the breakup fee, which is $1 billion? $1 billion. That's not bad. Mm-hmm. It's nothing to Musk. It's not really anything to Twitter either, though. Interesting language that's already in there. The other thing is that the judge says, hey, you got to buy him. Musk doesn't, just refuses. And then what happens? Boom, they lock him up, Frank. Then he's going to tweet from jail. What do you think about that scenario?
Yeah, they'll lock him. I think it's funny. It's so funny. They just totally go overboard, right? But
now, in his case, that's a possibility legally. If a judge says, hey, you do X and you don't, hell, it's kind of like a contempt of court, right? You could technically, right? It can happen.
You can go to jail for jaywalking. In some states, depending on what they arrest you on, that's what they do, and they'll get you in the room and say, you can go away for 37 years, which is the max, but you really do too. So I think it's funny when I look at this, Daniel. It's a battle of who's more full of shit, right? That's all it is. I'm serious. It's not even being funny. It's Musk buying Twitter. He says he's going to purchase $44 billion. That's $54 a share. And then, what do we have when he first made that announcement? Do you remember? A lot of that is actually removed because I went back to look at stories, and it's amazingly removed from a lot of places, which doesn't surprise me. But remember the uproar, right? That Twitter contacted all the leftist media. They went after Twitter. You can't sell it to him. He's an animal. Can't sell it. No way. We need to control this. No way. Yeah, Kramer come out and say, no way. The board's got to do his job and reject this offer at $54. I got to reject it. And then Prince Alaweed, who's one of the large shareholders, strongly rejected the offer, saying it's $54 a share. It doesn't come close to the intrinsic value of Twitter. Okay. Well, now the stock is $35. Where the fuck are you guys? Why aren't you buying the stock hand over fist if you think it's worth $70, you assholes? No, right? They're not buying it now. No, right now. So now it crashes. And now Twitter's like, okay, we know Musk isn't going to come to the table. We didn't have to hand in the data because I know it's not less than 5% of these accounts. If it's anything less than 20%, the dummy accounts and the bots and stuff like that, they're lying, right? We all know, we all see it, we all have proof of it. You could see 50 accounts saying the exact same thing word for word, especially when it comes to the political agenda. We all see it. It's there for you to see, right? So we all know it, and it makes sense to social media platforms to do this, to amplify the numbers. We get it, right? And it's so hard to track. So Twitter, right now, what Twitter's fighting for is they don't want Musk to buy it. They really don't. What they want is the breakup fee, and that's what they're fighting for. So,
but what good is that going to do?
Well, at least they get $1 billion in their pocket. Why not?
Yeah,
because it was such a fight. Granted, it's now $35, and now you're looking at your wallet going, holy cow, maybe we should have accepted that offer. Because when they made this offer, it was April. I think it was April 1st, April 2nd. And when they made the offer, the stock went from the 30s to $50. And that's when they were saying, no way, the intrinsic value is worth more. Remember, this is April. The market's crashing, especially technology companies, especially social media companies, Facebook. Everything is crashing. It's crashing. And they're rejecting this offer. I'm like, how could you just come out and reject? So they didn't actually come out. They had the media say it and all the shareholders say it. We reject. I think some employees even left from Twitter. Made a big deal about it. Now that it's crashed, they're like, well, maybe we want it. Now we want that offer. So it's going to be interesting if Musk actually goes there and accepts this offer. I don't know if that's going to happen or not. I don't think so. But I would like to see the data. And it doesn't seem to me like they made it public. But there's more of a bigger point here, Dan, that I want to talk to you about. There's a code when it comes to taking over companies. And it's not just law and legal, but when you make a bid for a company, yes, there's a breakup fee, but usually that breakup fee only happens if maybe somebody else comes in and buys you at the higher price. That's what the breakup fee is for. When you make a bid for a company, it means you're buying it. You did the due diligence. You announced it publicly. You're buying it. So to pull that rarely happens unless you find something under the hood. And a lot of times a company won't really, accept the offer. But we have a bid made and they accepted the offer on April 25th. So right there, the deal should go through. And he's asking for data points. He has to really prove that, they have a lot of bots and everything and whatever, that he didn't get to see the data because that code is if you have one buyer and the seller of the company and they agree, it should be a done deal. You got to look at the books and go through and do due diligence. And that's what he's saying. That didn't happen. If that didn't happen, that's fine. But most of the time in our industry, when you see that, the deal gets done. And then you have, Spirit and JetBlue or whatever. They're going back and forth because there's bidders there. And they keep raising their bids and they're going back and forth to shareholders. What's better? That's fine. That's normal. And whoever loses that bid is going to get a breakup fee. That's cool. Right? That makes sense because you do a lot of due diligence on it. Somebody comes in and ups your bid. You want to make sure you get paid and you don't waste all your time. So the code is once you make that offer accepted, it's usually a done deal. And the fact that it's not, if they cannot prove this, I think Musk is going to lose a lot of credibility here. They have to be able to prove. And for Twitter to come out and actually sue them, it means that they could prove it somehow that they gave him all the data and he just decided to just pass on the deal for some reason. So it's going to be interesting. To me, it's a soap opera. I think you have to avoid Twitter stock. And again, it's great because it's entertaining as hell, and people love to be entertained. That's that's our culture. We have to be entertained all the time, and this is entertaining. And Musk tweeting, which some of the funny tweets and everything. That's where we are right now.
Yeah. The interesting thing is, so Twitter's up a little bit above $36. It's up 6.5% today. You know who is buying shares is short seller Hindenburg Research. Now they're pretty popular. They're up there with Citron Research, and they've had a lot of good calls. They've had mistakes like everybody else in wrongs, but they tweeted out today they've taken a significant long position in Twitter. Now I don't know what significant is, but there's some arbitrage there, and I don't see how. Now today's easy because literally the stock is up right in front of our eyes today. But I do think the odds are in your favor if you wanted to be a trader, which I am a terrible trader. If you wanted to, I would, if you had a gun to my head, I'd play Twitter from the long side here because they're not going to court.
Why would you play Twitter from the long side?
Because I think the road less traveled is easier to go higher towards the 44 or 54 number, than lower. Mm-hmm. That's the only reason.
Okay. You may be right there, right? Because you're saying...
Again, as a trade, because if there's going to be a lot of headlines that come out around this because it's entertaining and it's got the richest guy in the world and one of the most popular platforms. If headlines are coming out as they gear up and does the trial get expedited? Does it get, it's going to get a lot of press. Markets move on headlines and things. If wind comes out or headlines come out saying, hey, Twitter's got a great deal, they're confident, they think that this is going to stick, I don't see how the shares don't at least melt up. I think it'd be crazy volatile, but if I had to choose, I'd play for a little bit of bump. And again, it's already up 6.5% today. So
here's why I don't agree with that.
Okay. Ooh, nice. So you take lower?
This is what Hindenburg's thinking. Okay, the stock's all the way down. If Musk could buy it, maybe at a little bit lower price they agreed to, that's fine. So if he buys it at 54, it's 35 right now, at 37 right now. After it's up today, that's fine. I get it. Or he goes away and you're saying, okay, here's, we're pretty much a lot lower than we were. And this is where it was trading pretty much right before the bid. So, I see they're thinking little risk. Here's where this could really blow up in their face. If Twitter really goes after Elon Musk and Elon Musk decides to leave this platform, that will crush this company. You got rid of Donald Trump, which was terrible for the company because Donald Trump, the amount of people that hate him were more than the people that like him, as you know, with the Howard Stern thesis. That's what creates volume. Massive volume is when you have people hating you and half of the audience come in and saying, no, you shouldn't hate this guy because you love him. It triggers all the algorithms and all social media. It's like the Peter Schiff theory. That's why he'll never kick anyone off that talks bad, regardless. And he's a genius when it comes to marketing. If he decides to leave this platform, the following that he has, it's 100 million followers. These are all the Bitcoin enthusiasts. These are the people that post millions of times. These are the people on social media all the time. This is will hurt them significantly, because it's not just Elon Musk and his Twitter followers. Everybody's talking about it. It's why it's being covered so much, because everybody's clicking this. Right? If you think about it, it's just the normal a guy wanted to buy a company and he doesn't think it's right and he's not buying it, right? If you remove Elon Musk and put in Icon, nobody cares. But the reason why it's getting so many hits is because he has that star marketing power and the massive, massive audience, and even the crazies and even the Reddit crowd and stuff like that. They love him. The Tesla crowd. I mean, Tesla wouldn't be this high if, again, the valuation doesn't support it, but it supports it because of Elon Musk. If he comes off this platform, this thing's going to crash into the 20s. That's what they should worry about. So this isn't a layup and it's come down and they might buy it. And I see it going along. Right now, without Musk, this stock is not worth $35. It's not even close to $35. And it's probably maxed out at its valuation right now if he pulls away. So if he doesn't pull away, you're going to sound like a genius. Or if he comes in at 48, 49, 50 instead of 54, again, you're going to make a lot of money. I wouldn't be taking my largest position here because Musk, you see him tweet, you see how nuts he is. He'll find another platform. He'll go someplace else. But if he's like, I'm done with Twitter, no more. I mean, you know how much traffic's going to come off that site? And I'm not just talking about the traffic from Musk, but
we don't know. We don't know the data.
It's going to be massive. It's going to be massive. And even, I mean, look at Donald Trump. Look at all the liberal stations and look at their numbers when Donald Trump lost the election. Look at them now. They're all like at 5-year lows, 7-year lows. They're all getting crushed. So you got to be careful who you kick off your platform, because the guy you hate the most is the reason why you're in business, because you got someone to talk about all the time of how much you hate him. And they miss Trump being president, these liberal stations, because you're looking at the data, looking at MSNBC, you're looking at the numbers absolutely crash with so many of these little media companies. It's interesting. That's the biggest risk. If Musk says, you know what, I'm not on Twitter anymore, the hell with you guys, goodbye, this thing could really, really, really get nailed. So it's interesting. Let's see what happens. For me, I would avoid it. This everything else out there. This is a story again. If you put a different name, take out Elon Musk, no one's really mentioned this. You're getting lots of hits, and we're talking about it right now because everybody's talking about it. We're getting questions on it. To me, it's really not a big deal. It's about one company, and you have both sides who are board of directors, a bunch of idiots. They should accept the offer right away. They didn't. They went to the liberal media to attack Musk, and then when the stock crashed, now you want to accept it. To me, it's just it's two clowns with a nice story that everybody's interested in, and I'm more worried about money and investments. To me, I think you have to avoid this.
Oh, I agree with that. I like that. Hey, I said if I had a gun to my head, what I'd do.
Yeah.
I'm not telling you to go leverage up.
They might be right, and Musk comes in, but I'm just saying if Musk leaves his company...
But hey, if the deal is a deal, I think the stock would go higher. That's all I'm saying. If the deal is a deal, and they get legality on it, I just don't see that. It'll just be fun to watch unfold.
I can't. Why would you purchase a stock now? Pay the $1 billion fee. Pay the $1 billion fee, because if you pay for the stock now, it's down. What is it? Probably about 12, 13 billion from the price you wanted to pay. Pay the $1 billion fee, and you save money.
Yeah,
and then you could buy more shares down here if you want. Right? You could buy more shares if you really think it's undervalued. But that's what pisses me off the most, because all these assholes that are saying the intrinsic value, it's worth much more when he came out 54. It's 35. Why aren't you guys buying? Why aren't you guys buying like crazy? Because you think it's worth a lot more at 54. You don't think it's worth a lot more at 35? That's what pisses me off, where it's like a joke. They think everybody's idiots out there when you see that. But let's see what happens. And for me, I would avoid it. But again, if you like to trade, it's probably going to be a good trading opportunity. You're going to see it all over the place, because if Hindenburg is really, really long, you could see a lot of shorts come in. It's going to be interesting to see both sides of how they play this, because I do see a lot of risk. It seems like there's no risk at 35, but there is a lot of risk at 35 if Musk pulls the rug out and says, I'm no longer staying on Twitter and I'm gone. And that's the biggest risk. So,
well, we'll watch it unfold.
Absolutely.
Stay tuned here.
And questions and comments. Daniel, what's your email address?
Daniel at CurzioResearch.com. Okay,
mine is Frank at CurzioResearch.com. If you have any questions, comments, feel free to email us. But that's it for us today. Tomorrow, really, 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 really great interview. I'm excited. I won't give it away, but it's a first-time guest and someone that one of the first women to do something, and it's right up my alley, which is amazing. And I'll give you a hint. It's she owns first woman, black owner of 2 professional basketball teams. So you can go look her up. We're going to have her on tomorrow. Just an amazing story, amazing person, and it's going to be a lot of fun. So I'll see you then, guys. Any questions, comments, get FrankCurzioResearch.com, and take care.